Hello and welcome to Portfolio Matters Weekly Markets Checklist, week 140. But before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities we own or have financial interest in. Please do your own research or consult a professional investment advisor for making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Before we get going, a couple of housekeeping items. Reminder, the next Discord chat with Rogue Trader is on Thursday, the 7th of December at 7:30 p.m. And before that, on Tuesday, the 5th, we will be having Christmas drinks upstairs at the Princess Louise High Holborn, 6:30. Hope to see some of you there. But first, the news. So this week we had the Chinese shadow bank Zhongxi fail with missing funds of 35 billion. Now, if you remember during the great financial crisis, problems in the US property sector rapidly led to problems in the US financial sector and then wider systemic economic problems. Are we starting to see a similar dynamic play out in China? The Berkshire Hathaway vice chairman Charlie Munger died at the age of 99. Their track record at Berkshire Hathaway remains extraordinary. I'll show you the figures in a second. So, US third quarter GDP was revised upwards from an already extraordinary 4.9% to 5.2% annualized. EU inflation massively beat the downside, falling month on month, minus 0.5% in November to only 2.4% year on year. Everywhere, inflation is coming in soft. And finally, yesterday, OPEC Plus agreed to extend their existing supply cuts and add a further 900,000 barrels a day of voluntary cuts. The market was unimpressed and unconvinced those voluntary cuts would actually occur. Oil fell on the day. Some charts relating to the news. Well, if you had invested in Berkshire Hathaway shares back in 1964, you would have got a return of 3.8 million%, which is absolutely extraordinary. Charlie Munger was an extraordinary investor. During the week, Fed Governor Christopher Waller gave a dovish speech in which he said that interest rates were high enough to contain inflation, i.e. that there would be no further rate rises that sent short-term bond yields falling. And the market is increasingly convinced that the US will cut rates next year. So the pink line is expected rates as of the end of January 2024, i.e. they're expecting no change. The blue line is expected rates by the end of June 2024, and you can see the market is expecting a 25 basis point cut in US interest rates by that date. And then the green line is the end of next year, and it is now pricing in a full 1% fall in US interest rates by the end of next year. This is oil prices. They had risen in advance of the OPEC Plus meeting, but then they were skeptical that the announced cuts would actually occur, leading to a sell-off in oil, and oil actually ended down on the week. We'll show you the details later. Okay, and on to this week's economic data, and it was a light data week. In the UK, we had the CBI Distributive Trade Survey, and actually that showed a bounce from very poor levels in October to only minus 11 in November. So that suggests better retail conditions in the UK, but still below zero, i.e. not great. The good news is that UK retail price inflation continues to fall. These are the November numbers, and retail inflation fell to 4.3% in November from 5.2% in October. And as you can see from the chart, there was widespread falls in food and non-food inflation. All the retail sales segments showed falling inflation, and that means that hopefully UK CPI inflation should also continue falling in November. We had the Bank of England consumer credit numbers. Actually, they were okay. They came in below expectations, but still, that is a decent number and does not suggest that the UK consumer is cutting back on borrowing. Mortgage approvals bounced up slightly, but remain around a third lower than pre-pandemic. Net mortgage lending remained negative. So in aggregate, more people are repaying their mortgages than taking out new ones. UK car production continued to bounce back, and that looks like a decent number. And this morning we had the nationwide house price index for November, and that came in at plus 0.2%. So despite the big rise in mortgage rates over the past year, the housing market continues to do okay and to defy the decline in housing affordability. Year on year, UK house prices fell 2% in nominal terms. CPI was 4.6% in October. So that implies that in real terms, UK house prices have fallen by about 7% over the past year. Okay, so in summary, UK economy continues to show unexpected resilience. Shop price inflation continues to fall, suggesting that overall inflation should also continue to fall. We expect the UK economy to slow further in the coming months as the delayed effect of rate rises takes effect. And onto the EU. EU inflation massively missed expectations in November, coming in at minus 0.5% against expectations of minus 0.2%. So the Eurozone is currently experiencing deflation. Now, this chart from Trading Economics has not been updated to include the November figures, but November was minus 0.5%. Year on year, November CPI fell to 2.4%, again, well down on October and below expectations. Eurozone inflation is fading fast. But I'm going to read this out. This is from SocGen, who say, we expect headline inflation to increase at the turn of the year because most governments will begin unwinding their energy support measures. Given our core inflation estimate and the ECB's sticky inflation forecast, we expect the ECB to keep rates unchanged for longer than markets do. We do not anticipate any rate cuts before end 2024, and next spring, the ECB may consider increasing quantitative tightening. So the market is currently dovish about the outlook for interest rates. SocGen are saying they're wrong, that the ECB is committed to keeping interest rates higher for longer. So this is the market's expectations for the ECB interest rate. And you can see the market is now expecting a full percentage point of cuts next year. Core CPI also missed to the downside, and that is very reassuring. It's still up 3.6% year on year and well above the ECB's 2% target. And potentially bad news for the Eurozone is that labour markets remain incredibly tight. So this is the unemployment rate, which remains almost at its all-time low at 6.5%, unchanged from October. We then have the Eurostat surveys for November, and they were largely unchanged. Economic sentiment unchanged, below 100, not deteriorating, but not really improving much. Consumer confidence actually rose slightly to minus 16.9, in line with expectations. Inflation expectations faded again, and that is actually a good number. Industrial sentiment declined to minus 9.5, but that is not much of a fall. Selling price expectations faded to 2.3, and that shows that again, Eurozone inflation would seem to be well under control and on a downward path. Services sentiment ticked up, but that is not a very exciting number. Bank lending to individuals continues to fall. That is year on year, 0.6%, below expectations and down from September. Lending to businesses is now negative year on year and also missed expectations. However, the Citigroup Economic Surprise Index is rapidly improving, suggesting that the Eurozone economy is no longer underperforming expectations. So in summary, the Eurozone economy already appears to be in recession, but it's a shallow recession that does not appear to be deteriorating much further. Inflation appears to be rapidly falling despite a tight labour market, and the labour market does not appear to be deteriorating very much despite the recession and tight monetary policy. And on to the US. Well, good news in the US on inflation as well. October PCE, personal consumption expenditure inflation, came in at 0, below expectations and well down on September. Year on year, it met expectations at 3% on a steady downward path. Core came in at 0.2%, in line with expectations, down on September. And year on year came in line with expectations at 3.5%, and that looks to be on a steady downward path. So inflation everywhere seems to be rapidly coming under control. And if you look at the contributions to core personal consumption expenditure inflation in the US, you'll see services inflation was actually negative in October. And services inflation previously had been a key reason for sticky inflation. And that implies that US inflation is actually well under control and likely to come down further. And whichever way you cut it, PCE inflation appears to be on a steady downward path. So this is super core, which excludes housing, and you see year on year 3.9%. The 3-month annualized is now 2.7%, so rapidly approaching the Fed's target. And if you look at trimmed mean, that is also falling. So the majority of PCE inflation components are also falling rapidly. Personal expenditure month on month in October came in at 0.2%, and that is consistent with falling demand and reduced inflation. Personal income also fell to 0.2%. Now, we have the second estimate of US GDP quarter on quarter for Q3, and that was revised up to an astonishing 5.2%. The second estimate of consumer spending came in at 3.6%, which was slightly down on expectations, but still a very strong number. Corporate profits were revised up massively to 4.1% annualized, which is in line with the revised GDP estimate. PCE inflation quarterly came in below expectations at 2.8%. So all the inflation numbers seem to show that US inflation is actually rapidly approaching the 2% target. And core PCE inflation, quarter on quarter in Q3, also came in soft at 2.3%, below expectations. Inflation in the US really does seem to be rapidly approaching the Fed's target, despite a resilient economy. House prices month on month continued to show resilience, up 0.2% in September. That was below expectations, but still positive year on year. Year on year, the Case-Shiller House Price Index came in at 3.9% in September, well above expectations. House prices are turning back up again. Now, we also had the Conference Board consumer confidence indices, and these are quite interesting. So the headline consumer confidence number came in at 102, up from October and pretty much in line with expectations. Now, this chart is a mess, and there are three axes. The blue line is consumer confidence, and that came at 102. But if you look at expectations, future expectations had a bounce, but are still very poor at 77.8, and present situation showed a decline to 138.2. So US consumers, actually their current situation seems fine, but they're worried about the future. Now, I had a few regional manufacturing and services indices. The Richmond Fed's manufacturing index for November came in soft at -5, but that's not a terrible number. Services showed a bounce to +1. The Dallas Fed Services Index also showed a bounce, but to a still poor -12. Now, it was Black Friday last week, and the Johnson Redbook retail sales year on year, which looks at same store retail sales, rose to 6.3%. But, and we'll show you this later, sales rose due to very heavy discounting. The US 30-year mortgage rate continues to fade, but it's still at very high levels compared to a couple of years ago. And the mortgage market index shows not much is going on. Very few people are taking out new mortgages. Initial jobless claims rose a touch, but as yet, there seems to be no big rise in people being laid off in the US. Continuing jobless claims rose sharply to 1.93 million, but that number is not what it appears. Okay, so this is quite a complicated chart. The number we've just shown you is the dotted grey line, continuing claims seasonally adjusted. The problem is, though, the seasonal adjustment has been badly affected by the pandemic. And instead, if you simply compare continuing claims with the pre-COVID average, and that is the dotted black line, you'll see the continuing claims actually fell last week compared to the pre-COVID average. So that rise in continuing claims last week is purely a function of the seasonal adjustment. There is no evidence of a sustained rise in US unemployment. And as a result, the SARM rule has actually fallen. And a reminder, the SARM rule looks at the percentage of states where unemployment has risen above 0.5% above its long-term average. And as a result, it is not showing any signs of an imminent recession based on unemployment claims. The New York Fed's Q4 GDP estimate remains pretty good at 2.33%. The Citigroup Economic Surprise Index for the US is fading, continuing to fade, still positive at 28, but falling. And Atlanta Fed's GDP Now estimate for Q4 remains at 2.1%. However, the US Beige Book survey, in which regional feds provide much more of a narrative of how they think the economy in their region is doing, actually showed a sharp drop in November. So, is the US economy finally starting to show some signs of weakness? And reminder, unemployment is a lagging indicator. So we would not expect to see a sustained rise in unemployment probably until after recession has started. Now, yesterday I had my usual weekly call with the US fund manager, and he was saying he felt, based on his own experience, that the US economy was finally slowing. So in summary, good inflation numbers in the US as in the EU, but the economic data, hard data, seems to show that the US economy remains resilient, but there are some indications that it's finally starting to slow in the form of the Beige Book and the falling Citigroup Economic Surprise Index. And on to China. So Chinese loan growth came in above expectations, but well down on September, and actually not that bad a number. And we had the National Bureau of Statistics manufacturing PMI, and that was weak, coming in at 49.4 in November, slightly down October, and missed expectations of a small bounce. Non-manufacturing was disappointing, coming in at 50.2, down on October and well down on expectations. Expectations were for a bounce, which did not materialize. As a result, the composite continued to decline, although it remains in expansion territory. And then today we had the Caixin manufacturing PMI, which is a private sector survey, and that showed the opposite. It showed actually quite a strong bounce in manufacturing PMIs in November. So in summary, the official PMIs show a weaker Chinese economy than does the Caixin. And according to the official PMIs, the Chinese economic recovery appears to be faltering in November. The Caixin non-manufacturing PMI should be out next week. Okay, and on to one chart. And all this year, we have been struggling with what is the level of US excess savings. And you remember that the Fed had previously estimated that the excess savings from the pandemic had been exhausted in the US by January, which did not seem to fit the data given the continued strength of the US consumer. Well, this week, the San Francisco Fed upgraded its estimate of cumulative aggregate savings in the US, and it now thinks that savings weren't exhausted in January. In fact, there's still a lot left. They are estimating that as of the end of September, there's still 430 billion of excess savings remaining, and that helps to explain the continued strength of the US consumer. And if we assume that cumulative excess savings are exhausted at a constant rate, then that means that excess savings will have been completely eliminated by the end of the first quarter in 2024. At which point, US consumers will have to start pulling in their horns. And you can see that currently US consumers are spending down those excess savings, i.e. they are spending more than they're earning, which is unsustainable. And actually, they seem to be drawing down those excess savings at an accelerating rate. And on to the US fiscal deficit. So thank you to one of our viewers, Andy, who emailed us at info@portfoliomatters.co.uk with a piece from the Global Times, which is a Chinese newspaper, and they were reporting that this year the US fiscal deficit has been increasing by $833 million per hour. Now, is that true? Actually, it's not. So the White House is forecasting that the US fiscal deficit for 2024 will be $1.8 trillion. And that works out at only $211 million an hour, which is still an absolutely frightening number. But it is not $833 million an hour. But that still implies a deficit of almost $5 billion a day. As a result, the forecast interest payments are just going through the roof. Unless something happens in the form of fiscal responsibility or a fall in interest rates, then the US fiscal deficit is out of control and unsustainable. Now, according to my US fund manager friend, he does not see any prospect of fiscal responsibility taking hold before the next election. But after that, he thinks that the government will do something. So at some stage, somebody has to do something about the US fiscal deficit, and we can only wait and see what happens after the next election. Okay, and on to Japan. Now, I found this very interesting. This is from Robert Armstrong at the FT. The Japanese economy has been an enduring puzzle over the last 30 years. It has continued to add debt and do QE, but this has not led to inflation or an economic or financial crisis. And the economy has done actually okay over that period. So Japan has an enormous national debt equal to 3 times GDP, and it's been doing QE and yield curve control for years now. And despite that, it has struggled to achieve 2% inflation. So Japan has been a puzzle in that it seems to show that you can run enormous fiscal deficits while suppressing interest rates and still not get either inflation or a financial crisis. But the Japanese economy may not be all that it seems, because the Japanese government is running the economy like it's an enormous hedge fund. This table on the right shows the change in the government balance sheet between 1997 and 2021. And you'll see there's massively increased its liabilities, i.e. its borrowings, but it's also massively increased its holdings of equities, both domestic, but most importantly, foreign. And so what it's doing is it's borrowing cheap from domestic savers at artificially and suppressed interest rates, and then it's investing the money overseas and earning good dividends. And the numbers involved are not small. It's estimated that Japan is making around 3% of GDP per annum from this trade. And that comes at a cost to domestic savers who are receiving artificially low interest on their deposits. Now, what could go wrong with this? Seems to have worked very well for a long period of time. Well, Japan is essentially highly geared and long equities. And that trade works as long as equities do well and the world economy does well. But if we fall into a global depression and dividend income falls, then the fiscal deficit would widen and this whole trade could unwind. They still have to pay the interest on their outstanding debts, but their income from foreign dividends would fall. The thing to take away is that Japan turns out to be highly geared to global equity markets. And on to zombie firms. We have previously talked about how a large percentage of companies in the US stock market have negative cash flow. And the concern is that as interest rates have risen, these companies will have difficulty funding themselves because, by definition, they need to constantly raise debt to keep funding their unprofitable operations. Now, are we right to describe these companies as zombies? So this chart shows that around 30% of the Russell 3000 companies are unprofitable. And that's from the FT. And we know that bankruptcies in the US are rising. So that would also seem to suggest that all these unprofitable companies are having trouble and failing. But actually, most of these companies are not zombie companies at all. They're companies, they're growth companies where they're currently cash flow negative, but the market remains confident that they will succeed. And they are cash flow negative because they're currently investing to grow. The dark blue line is companies in the US which have negative EBITDA, but the equity is not underperforming. So the market is confident they'll be okay. The blue line is negative EBITDA, but equity underperformance. And you can see that is a much lower number. It's still substantial at about 10%. But the majority of companies in the US with negative EBITDA are growth companies, and the market is confident they will do well, and that's nothing to worry about. And really, when you look at the distribution of credit ratings in the US, it looks pretty normal. We know that credit rating agencies have been doing a lot of downgrades recently, but the number of companies rated CAA and below, i.e. in deep distress, is pretty normal. Over 50% of the companies with negative EBITDA are in the tech and health tech sectors, i.e. they're unprofitable startups. So in summary, the US does not seem to have a problem with zombie firms, actually. Most of the companies with negative cash flow are startups with decent prospects. Caveat, as long as they can keep securing funding. And on to Inflation Watch. So we had two new numbers this week. We had German inflation, which came in below expectations at 3.2%, well down on October. Core was at 3.8%, both well above 2%, but falling quickly. In Japan, inflation actually ticked up to 3.3% in October, and core was at 2.9%, also up. Now, this is from Robin Brooks of the Institute of International Finance. And what this shows is that if you look at the combined weight of US PCE inflation components, which are growing at less than 2% per annum, it looks pretty normal. And his point is that inflation has not broadened out into the whole economy. Instead, it seems as though inflation never really took hold in a continuing basis. And what we've seen is a supply shock. So inflation in a few components went very high, but is now fading again, which is all well and good, but even a supply shock can lead through to sustained inflation if you get a wage price spiral. And obviously wage inflation has been high in the US, although it's coming down, and wage inflation has been very high in the UK. So the point is that even if you get a supply shock, you have to make sure that inflation expectations do not become embedded. Now, everywhere inflation is coming down, but economists are expecting the improvement in inflation to slow in the coming year, to the extent that they're expecting US inflation to still be 2.5% by the end of 2024. That means the Fed will have to keep rates higher for longer. Now, we talked earlier about how US retail sales had a strong bounce last week. Well, it came at the cost of heavy discounting. You see, this is the price of various goods in the shops last week in Black Friday, and you'll see that they were discounted by up to 25% in the case of computers. The data I've seen shows that overall retail sales were up 2.5% in nominal terms. So there must have been a big jump in volumes, given that there were big cuts in prices. Now, in the UK, inflation is also fading quickly, and you see that the number of companies reporting labor shortages is fading quickly, in part because we've had enormous immigration. We'll show you the chart. We talked about that last week, but we'll show you another chart this week. This is German inflation coming down very quickly. Core also coming down. Japanese inflation, though, ticked up. Has Japan finally managed to achieve sustainable inflation? In fact, are they now going to struggle to get inflation back to the 2% target? So in summary, inflation is falling faster than expected everywhere, but the pace at which it's dropping is expected to slow next year. And we know labour markets remain tight, and central banks are concerned that tight labour markets mean continued wage inflation pressure. Expect them to keep rates higher for longer. And on to recession watch. Now, this is very interesting. So this is from the US National Association of Credit Managers and its bankruptcy filings, which you're seeing rising. But the commentary was also interesting. In a marked change from recent prior months of the Credit Management Institute survey, credit managers are sounding the alarm on account performance, ranging from more accounts delinquent, poor application quality, and more bankruptcies. So credit managers in the US are seeing a credit deterioration. But despite that, bond markets seem very relaxed. Credit spreads have actually been contracting. Credit markets are not anticipating a rise in bankruptcies. We previously talked about employment growth in the US and its continued and unexpected resilience, well, that is mainly due to the public sector. So if you split US jobs growth into the education and health, i.e. public sector, and non-farm payrolls minus education and health, i.e. the private sector, you'll see private sector jobs growth is falling rapidly, although it is still positive. And that suggests the US economy is slowing. And the US yield curve inversions have bounced back up and continue to forecast an imminent recession, although we've been saying that for over a year now. Corporate borrowing costs have been rising, even for the S&P 500, although most companies have locked in cheap long-term borrowing. And this is from us at Portfolio Matters using the St. Louis Fed numbers, and that is the credit impulse. And the credit impulse in the US continues to decline. So that means investment is declining, and that is bad for GDP. Reminder that investment is not all spent in one go, it's spent over the course of the coming year. So that implies a negative impulse to GDP growth from investment over the coming year. And interesting that wealthier Americans are also feeling the pinch. So this is the spending growth in the black line for high-end brands, and you'll see that year on year fading, much worse than national retail sales, which remain positive. So actually, wealthier Americans have not been supporting the economy. And visits to shopping centers in the US have shown a marked deterioration in October and are now negative year on year. This is job postings to the Indeed website, and you'll see that job postings in the UK, which is the blue line, are fading but are still above pre-pandemic levels, although not much. The same is true in the US, but the US labor market remains much tighter than pre-pandemic. So there are 25% more job postings than there were pre-pandemic. The US jobs market remains tight. Now, those are the seasonally adjusted numbers. If we look at the numbers without the seasonal adjustment, you'll see that it is falling more quickly, but you can see there is always quite a big drop in new job postings pre-Christmas. This is German unemployment, and you'll see that's actually shown a sharp rise over the course of this year, which is puzzling given that we know that EU unemployment has shown almost no rise at all and remains very close to its all-time low. Now, if we look at and taking a closer look at Germany, well, employment expectations have been negative for much of the year, and services employment expectations are also fading. It looks like Germany is entering a normal recession where the first sectors to shed jobs are manufacturing and construction. And then when people from those sectors have lost their job, they cut back on spending, leading to a general contraction and job losses in the other sectors. So in summary, we continue to expect a recession on both sides of the Atlantic as the lagged effects of interest rates rises start to bite. The US economy has benefited from the US consumer continuing to spend excess savings built up during the pandemic, but those appear to be becoming exhausted. So will we finally see the US consumer start to cut back over the course of the next few months? And while we're talking about the US, let's have a look at the US economic cycle. So all these charts from Patrick Zweifel, and they start from the first quarter in which residential investment in the US started to fall. And you see it's now been 9 quarters since the peak in the US residential investment. And if you compare this cycle to previous recessions, you see that residential investment looks normal. It's slowing down as you would expect in a normal recession. And if you look at manufacturing, that also looks like a normal recession. So why hasn't the US economy slowed down and had a recession as you might expect from those two sectors? Well, because of services. The strength of services has been absolutely extraordinary, supported by the excess savings built up during the pandemic. You can see that actually it's now starting to come back to more of a normal trajectory. But you also see that during a normal recession, services does not slow down until later. The way a recession normally works is that manufacturing and construction slow, and as they shed jobs and people cut back on their spending, so services finally slows. Services slows late. And the other thing that has supported the economy is non-residential investment. And that is reshoring and investment in new manufacturing capacity mainly in the semiconductor sector. And you see that has continued to support the economy. Is that finally peaking? The other thing that supported the economy is that during the pandemic, the private sector repaired its balance sheet. So one of the reasons the US government has got so much debt is that during the pandemic, there was a big transfer from the public sector to the private sector, allowing the private sector to rebuild their balance sheets. And so they can now borrow. And we showed you this chart earlier, but the latest estimates are that the US consumers still hold excess savings, although there's always a question of the distribution of those savings. So if they're mainly held with the wealthy who don't spend them, then those savings will not be supporting the economy. And we know that there is already signs of quite a lot of distress amongst lower paid workers in the US, as evidenced by the rising default rate on credit cards. But although US consumers do have the capacity to increase their borrowing because they've got strong balance sheets, they have actually been borrowing less. So consumer credit growth is now running at only 1% annualized as of the last 3 months, because obviously the cost of debt has risen, and we know that credit card interest rates are at an all-time high. So consumers are not taking out many new loans. And also, manufacturers are reducing their future capital expenditure intentions, and that is the grey line. And they're now expecting to cut back in the coming year. So does that mean non-residential investment, which has been supporting the economy, will now start to fall? So non-residential is the brown line. And one of the reasons that they're cutting back on future investment is that their capacity utilization is falling. And that is the left-hand axis. And if they're not using their existing capacity, then they have little incentive to add new capacity. So in some ways, so far, the US economy has been supported by strong services and strong non-manufacturing investment. But both can be expected to slow in the coming months. And the US consumer has been living beyond its means by drawing down excess savings from the pandemic, but likewise, it can't do that forever. So we're still expecting the US economy to slow next year. And on to soft landing watch. So the labor market differential is the difference between the number of US consumers saying that it's easy to find a job minus the number of ones who are saying it's hard to find a job. And the black line is now, the other lines are previous recessions. And what it shows is the labor market remains tight. People still find it easy to get a job, and that is not the pattern you normally see in a recession. Although you look at 2001, the labor market didn't really slow until the recession had already started. And importantly, the labor market differential is not really deteriorating, as you would expect in the run-up to a recession. And the fall in bond yields over the past month has meant that financial conditions have eased significantly. So companies should find it easier to fund themselves. And as we've shown you this before, credit spreads have fallen. The market is not concerned about corporate bankruptcies. And looking at the central banks of the world in entirety, they've started to loosen. So bottom line is that inflation everywhere is falling, labor markets remain tight, economies show resilience, and the US is slowing, but it's slowing very slowly. Nowhere is there a sign of a hard landing. And on to AI. So one of the big stories of the year is ChatGPT and the development of generative AI. Now, the question is, how is that going to affect the economy, and is it going to take white-collar jobs? Well, the FT reported on an academic research paper which looked at exactly this issue. So what they did was they looked at an online platform where people bid for writing and editing jobs. And they looked at the number of jobs on offer and the price of those jobs before and after ChatGPT went live. And so what you see is the advent of ChatGPT has led to a steady decline in the number of jobs on offer and a sharp drop in the price of those jobs. So the number of jobs available has fallen by only around 3% compared to pre-ChatGPT, but the price of those jobs has fallen by around 10%. And if we look at the impact of ChatGPT, well, Boston Consulting Group did an experiment where they split their staff into two groups, and they only allowed one of those two groups to use ChatGPT. And then they looked at the productivity of those two groups. And you can see the right-hand chart, the ones who used ChatGPT tended to be more productive, and with the effect most pronounced for the lowest skilled workers. And their productivity was boosted by 40%, whereas the most skilled participants showed no boost to their output quality. So ChatGPT seems to boost the productivity of the least skilled professional workers by the most and should lead to a general increase in productivity. So in summary, AI is already here and is likely to impact the creative and knowledge economies far more than the manual economy. And the bad news for freelancers is that it seems to reduce both the quantity and price of their work. And onto other charts. Well, these are German exports to China, and they're down about 10% from their peak over the last year. So the question is that a structural or a cyclical peak? The weakness in Germany's economy means that the pigs, remember them, who used to be considered a problem and a risk to the future of the Eurozone, well, now they are the strongest growing economies. So Ireland is expected to be the strongest growing economy in Europe in 24 and 25, followed by Greece, Spain. Portugal is number 5. Italy is that number 8, but still doing better than Germany. Now, turning to China, these are bad loan provisions for Chinese banks, and they are steadily rising. We talked earlier about the failure of Zhongji. The problems in the Chinese property market could yet cause a wider systemic crisis. And funding for Chinese property continues to slump, which suggests that property investment is going to remain weak. Now, returning to the question of UK immigration, which we discussed last week, well, the rise over the last couple of years in UK immigration is absolutely extraordinary and unprecedented in history. So this is a chart showing the net rate of immigration from the UK over the last, 150, almost 200 years. So in the 19th century, we had net migration, presumably to the US, and actually, even to the beginning of the 1980s, we had net migration. Then in the last couple of years, we have had net immigration of over 1% of the total population of the UK in a single year. Just absolutely unprecedented. And if Brexit was in part a vote to try and control immigration, well, it really hasn't worked. You've seen that post-Brexit, immigration has surged. Now, we know that around 40% of those new immigrants are students. So presumably they won't stay forever, or we hope not. But that still means they have to have accommodation here. And that is a lot of people who need to find housing. And that's going to increase housing costs and rental costs. Now, a contributor to net immigration is the fact we are unable to return small boat arrivals into the UK back to Europe as we used to do pre-Brexit. But these numbers are really small. So in 2020, you're talking about 120 people as opposed to, 30? These are not big numbers in the context of net immigration of 700,000. So frankly, this is not the problem. Returning small boat arrivals is minuscule compared to the overall size of immigration last year. Some good news is that when you look at US wage growth, then the top 10%, which is the turquoise line, their wages have not kept up with inflation, whereas the bottom 10% have seen around an 8% rise in their real wages since the pandemic. So that reduces inequality and is good news. And more good news. So we're in the process of transitioning away from vehicles driven by internal combustion engines to batteries. But batteries contain a lot of trace elements, and they're very difficult to recycle. They have not been designed to be recycled. And the current method involves some very nasty chemicals and grinding the whole thing into dust from which the heavy metals are recovered. Now, researchers in Sweden have developed a better method, which they claim will allow 100% of the aluminium and 98% of the lithium to be recovered. Everywhere, we're going to have a big battery recycling problem in the coming years. Let's hope that future battery designs have recycling in mind. And on to equities. Well, it was a decent week for the world equity index, up 0.4%, up 14% on the year. The all share up 0.2%, pretty much flat on the year. Euro stocks continuing to defy the rise in interest rates and a slowing Eurozone economy, up a further 1.1% on the week, up 9% on the year. S&P 500 up 19% on the year, entirely due to the NASDAQ, which is up 36%. Absolutely amazing. Russell 2000 up 0.7% on the week, up 2.7% on the year. Hang Seng had a terrible week, down 4.2% and down 15% on the year. Topics down 0.3% on the week, up 26% year to date. Bitcoin continues to shoot to the moon, up 2.4%, up 131% for the year. Sterling had a good week, up 1% versus the dollar, up 4.6% year to date. The euro was flat on the week, up 1.8% year to date. And the dollar index faded by 0.4% on the week, flat on the year. VIX, amazing. It rose 1%, but it's still very close to all-time lows at 12.9. Despite everything going on in the world, all the uncertainty, the markets are not anticipating any volatility in stock markets. Greed is back. I've had an incredible few weeks in the equity market. Suddenly, everyone's optimistic. And the rise in the S&P 500 the last couple of weeks comes despite a steady deterioration in the Bloomberg US Economic Surprise Index. So it's not driven by economic fundamentals. How long can this continue? Is it just the end of year rally? And if the end of year rally continues, expect the S&P 500 to continue rising to year end. Now, this year, it's all been about the Magnificent Seven, who are up 80%, whereas the other 493 components of the S&P 500 are up less than 10%. And if we look at this decade, i.e. since December 2019, you'll see that the same pattern is repeated. All the returns of the US equity market pretty much come from the Magnificent Seven. Brokers continue to be bullish for 2024. Reminder that coming into 2023, they were for once bearish. It's very bit rare for analysts to be bearish about the outlook for the S&P 500, but they are generally forecasting it would fall in 2023. Of course, they were wrong. It's risen quite sharply. So this year, they're expecting 2024 to be a good year. Everyone apart from JP Morgan is expecting the S&P 500 to rise sharply. And reminder, this is the expectations for the S&P 500 for 2023. The analysts were net expecting it to fall. Of course, it's risen sharply. So the consensus is invariably wrong. And on to commodities and energy. So despite the OPEC meeting and OPEC Plus agreeing further cuts, oil had a poor week, down 1% and down 6% year to date. And WTI also down 0.7%, down 5% year to date. Numbers specific to the oil market, well, there was yet another build in the US, including the SPR. There's a build of 3.2 million barrels, excluding the SPR, there was 2.9, implying that there was a small refill to the SPR last week. US crude production stayed at an all-time high of 13.2 million barrels a day, and the Baker Hughes rig count was steady, unchanged at 500. Now, the US has now seen builds in crude inventories for 6 weeks in a row. So the US market is well supplied, and that suggests little upside to oil prices. And US gasoline prices have been falling for 60 days in a row, which will support the US consumer and hopefully lead to lower inflation expectations. Despite the cold snap, EU natural gas prices fell by 6.5% last week. UK natural gas prices fell by 8%, down 40% on the year. US natural gas prices faded as well, down 5%, down 38% on the year. Coal had a bounce, up 8% on the week, still down 66% year to date. I suspect this is related to, COP26, and the Chinese and the Indians have made it very clear that they expect to continue to burn a lot of coal. Uranium fell 1.5% to 81, although this graph doesn't appear to show that. But it's still up 66% year to date. And onto industrial metals. So aluminium continued to fade, down 1.3% on the week, down 7.6% year to date. Cobalt, reminder, cobalt is extremely oversupplied. The price was unchanged on the week, down 36% year to date. Copper is continuing to recover, up 1.9% on the week, now up on the year. Chromium fading, down 1.5% on the week, down 8% for the year. Iron ore down from its recent high, but still up almost 13% year to date. All that is on the back of strong expected Chinese demand. Lithium fading fast, down another 11% on the week, down almost 80% on the year. Neodymium also fading, down 1.6% on the week, down 36% on the year. Nickel stable, but still down 45% on the year. Tin, bad week, down 4.7%, and is now down 5% for the year. Ferrovanadium down 3.1% on the week, down 30% on the year. And zinc also down 17% on the year. And on to precious metals. The fall in bond yields has been good for gold. And that is approaching all-time highs at 2042, up 2.4% on the week, 12% on the year. And is gold breaking out? It is, of course, being supported by dollar weakness. Silver also had a very strong week, up 7.1%, up 5.6% on the year. Platinum had a bounce, but still down 13% year to date. Rhodium also had a small bounce, but is looking dead, down 64% on the year. Palladium down 3.4% on the week and down 44% on the year. Finally, on to rates. Well, over the course of the last month, the whole yield curve has shifted down as inflation has come in lower than expected, and it looks like global inflation is truly under control and fading. And the same is true in the US. Now, the market is not expecting the UK to cut interest rates until August next year. And one of the contradictions in the market is that you can only expect Bank of England and other central banks to start cutting interest rates when the labour market has slowed, and therefore wage pressures have slowed, and that implies further weakening in the economy. So equity markets have done extraordinarily well this year, despite the rise in interest rates. But interest rates are going to stay high until the labour market slows, and that means economic weakness ahead and slowing earnings growth. Can equities continue to do well? And US bonds had an extraordinarily good month in November, one of the best ever. And I thought this was a really useful and interesting chart. And the blue line is the oil price. The white line is the US 2-year break-even inflation rate as backed out of bond yields. And you can see that they're highly correlated. So rising oil prices mean rising bond yields and inflation expectations. But according to this chart, the fall in the oil price seems to be fully discounted in the lower US 2-year break-even. So inflation expectations have already adjusted to the fall in the oil price. This is UK 2-year, which has fallen very substantially since its peak in July and is now 4.6%, down almost 1% from its peak. 10 years also fallen quite sharply from its peak, down 50 basis points, and the 30-year is also well down. But you'll notice as we go through the other charts that UK yields have not fallen sharply over the last few weeks. In essence, they have bounced strongly after the autumn statement. So the bond market is demanding an yield premium to invest in the UK after Jeremy Hunt's autumn statement, in which he loosened the purse strings, and the bond markets are worried about the sustainability of UK debt and having to digest increased gilt issuance, and also about whether the increases in the national insurance, etc., will support spending and therefore support inflation in the UK. You'll see that in contrast to the UK, US yields have continued to fall and down a long way from peak. German bunds, that is a huge fall, not replicated in the UK. Same in Italy, same in Greece. No change to our views. Pause, take a look, and concluding comments. Well, everywhere, inflation continues to fall faster than expected, which is great news. Now, you would hope that that leads through to falling bond prices, because with falling actual inflation should come falling inflation expectations. And we are seeing that everywhere, apart from in the UK, where bond markets are concerned following the autumn statement. So in summary, inflation continues to fall faster than expected, and we're expecting UK and US numbers for November, and hopefully those will follow the Eurozone in dropping, continuing to drop. The latest economic data suggests the Eurozone economy is stabilizing, although it remains in a shallow recession, while there are some indications that the US economy may finally be slowing. And finally, on to me. Well, I had a poor week, down nothing but flat. Very disappointing, actually, given that Bond yields all around the world are falling, apart from in the UK, where Jeremy Hunt has managed to upset the bond market, and the UK bond market has not participated in the global rally over the last couple of weeks. So that puts me down almost 14% on the year compared to the all share, which is pretty much flat. So a terrible year for me. And I have been betting on and expecting the rapid rise in interest rates to lead through to a recession and falling bond yields. But that has not happened. But the Bank of England continues to keep rates high. Inflation is fading, and you would have expected fading inflation, and inflation has fallen quite sharply over the course of this year, to lead through to falling bond yields. And at some stage, I expect that to be true. If the Bank of England can get inflation expectations back to 2% by getting inflation back to 2%, then expect UK bond yields to keep falling, and that should be good for me and help me recover some of my enormous losses. And that's it. So we are now in the final month of the year, and I can generally feel the events slowing down as we all anticipate Christmas. We will have a normal PM next Friday, and then the schedule will be disrupted by the holiday season. Hopefully, Richard will return next week. In the meantime, please can you press like and subscribe to the channel. And it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.